Bob just panic sold his stocks, bought crypto at the peak, financed a brand new truck, and turned down free money from his employer, all in the same month. If you think this is exaggerated, wait, we're breaking down 8 of these mistakes, one by one, with real numbers, and at least one of them you're probably making right now. Today we're going through the 8 most common ways people lose money, not because people are stupid, because these mistakes are surprisingly logical in the moment, and catastrophic 20 years later. By the end of this video, you'll know exactly what each one costs, in dollars. Let's go. Mistake. Chapter 1. Panic selling during a crash. The market drops 20%. Bob sees the red chart and sells everything. The market recovers 7 months later. Bob doesn't, because he's already sitting in cash, waiting for an even bigger drop that never comes. Historically, someone who panic sells during a crash and buys back in later loses roughly 3–4% in annual returns just from bad timing. Over 30 years, that's a difference of hundreds of thousands of dollars. Mistake number 2. Financing a new truck. Bob finances a $40,000 truck at 7% for 5 years. The payment comes out to almost $800 a month. The moment Bob drives it off the lot, it loses 20% of its value, $8,000 gone before he hits the first red light. If Bob had bought a reliable used truck for $15,000 in cash and invested the difference, roughly $600 a month, at an average annual return of 8%, he'd have almost $45,000 invested. After 5 years, instead of watching a new truck lose a huge chunk of its value. Mistake number 3. Turning down the employer match. Bob's company offers a 401k match. The company adds another 50 cents for every dollar Bob invests. Bob skips it because he needs the money now. If Bob contributed $300 a month, the company would add another $100. That's $450 a month, growing at an average annual return of 8%. Over 25 years, that's nearly $400,000. Bob isn't turning down a little extra. He's turning down free money that doubles part of his paycheck and then keeps growing on its own. Mistake. Number 4. Lifestyle inflation. Bob gets a $500 monthly raise. That same week, he rents an apartment that's $400 more expensive and signs up for 3 streaming services at once. This is lifestyle inflation. Every new dollar automatically finds something to spend itself on, and your lifestyle grows exactly as fast as your paycheck. If Bob invested just $250 of every raise instead, after 10 years, he'd have roughly $45,000. Instead, 5 raises later, Bob's savings are still exactly zero, but Bob's most expensive mistake isn't the one you're thinking of. It doesn't even look like a mistake. It looks like caution, and that's exactly why it costs the most. Mistake. Number 5. Keeping everything in cash. Bob has $15,000 in savings. He keeps it in a regular checking account, earning 0.5% because investing is scary. Bob thought he eliminated risk. He didn't. He simply replaced market risk with guaranteed inflation. Even a high-yield savings account would have done far better. Over 10 years, that same $15,000 in a regular account loses enough purchasing power that it's really only worth about $11,000 in today's dollars. Invested in a diversified portfolio instead, it would have grown to roughly $32,000. Mistake number 6. Credit card debt at 22%. Bob buys a $2,000 TV on a credit card and pays only the minimum every month. At 22% interest with minimum payments, that TV takes over 7 years to pay off, and the total cost climbs past $3,600. The TV ends up costing almost double, and Bob barely notices because he's only paying $40 a month. Paying off a 22% credit card is like earning a guaranteed 22% investment return. Almost nothing else comes close. Mistake number 7. Trying to time the market. Bob waits for the market to dip before investing. He waits a month, then another. Bob waits 12 months for the perfect entry point. The market gains 12%. His perfect moment ends up costing him money. While Bob waited for a better price, the market never waited for him. Mistake number 8. Buying things to save money. Bob buys the extended warranty on his washing machine just in case. Then he grabs 3 more things he never planned to buy because they were on sale. Extended warranties are priced to make money for the store, not to protect Bob. That buy one, get one free deal only saves money if Bob actually needed the second one. Every time, Bob thinks he's saving. Every time, he's really just prepaying for a risk that almost never happens. Nobody wakes up poor because of one terrible decision. They wake up there because of 1,000 reasonable ones. Wealth isn't usually built by brilliant decisions. It's protected by avoiding expensive mistakes, panic selling, financing status, turning down free money, lifestyle creep, cash quietly losing value, 22% debt, waiting for the perfect moment, buying things to save. None of these 8 look like a disaster in the moment. Avoid just one of these mistakes, and your future self will probably never know how much money you saved. Avoid all 8, and that's how wealth quietly gets built.